War equals market crash. Or does it? What can we learn from past conflicts? And how can you best protect your money right now? Hello, member super savers and course fans. I hope you're healthy and well, despite what we're seeing in the markets and the media currently. So let's try to put things into context, especially since it is a bit disheartening to wake up every day and see the barrage of bad headlines, whether that's about the war in Iran, surging oil prices, and possibly inflation, or the latest, not so greatest, employment report. Wars can be unsettling to investors, and markets have often, but not always, experienced a sharp initial dip when conflicts have escalated in the past. So, with that in mind, here are the 3 topics that we'll be covering today. 1. Have wars always been followed by a stock market crash? And if yes, how painful was it? 2. Should you hold cash, bonds, or stocks if you fear a recession is coming? And 3. What are some additional words of caution that we'd like to share with you during these uncertain times? Let's dive in now, folks. Have wars always been followed by a stock market crash? And if yes, how painful was it? As the industry mantra and our disclaimer goes, past performance is not indicative of future results or events. That said, whenever a war or conflict is looming, and more generally, whenever markets start turning south, there is a tendency to look at what's happened before, in the hope that history may give us at least some insights into how things may turn out this time around. And most of us have probably seen different rankings of bad periods in the stock market that are based on either the severity of the drop or the length of recovery. Meaning that when folks talk about bad periods in the stock market, they often say things like the market dropped this much or the recession lasted this long. But that doesn't always tell the full story. For example, relatively short-lived episodes like the decline of the Dow Jones by 22.6% on Black Monday in 1987, to this day the largest one-day percentage drop in history, felt very scary to traders who lived through them. But because the markets recovered quickly, memories started fading fast as well. The bear markets that do tend to stick in most people's minds are those that see both steep falls in stock prices and last for a long time, like the 1929 crash and the Great Depression. Paul Kaplan of Morningstar has developed a method that combines these 2 dimensions, how far the stock prices declined and how long it took for a full recovery to the previous peak, into one single pain index number that makes bear markets comparable. We won't go into details on how Kaplan does it, but in essence, if we look at his pain index chart, the steeper the market falls and the longer it takes to get back to the previous peak, the bigger the red area on this chart and the bigger the pain. So for example, we can see the deep drop here for the 1929 crash and the following depression and a large red area. And maybe not surprisingly, the 1929 crash ranks as the most painful market crash of all times, according to Kaplan's methodology. For today, though, let's look at this chart with a slightly different lens to answer our question, have wars always been followed by a stock market crash? And if yes, how painful was it? And let's start with a quick look at the 2 world wars. Both were long, painful, and costly conflicts that coincided with major stock market crashes, as you can see here from the falling market prices and the large red areas. Now, it's not always that simple. For example, the market had already been through a period of weakness since 1913, even before the start of World War I triggered the full-blown financial crisis of 1914, and it had some ups and downs in between. But we'll skip on the details for the purposes of this video and just say that overall, both world wars were not good for stocks. And even after the wars had ended, it took the market a while before it fully recovered. In the case of World War II, we can even see a separate post-war bear market here after a short initial rally. So far, as expected, investors generally don't like wars and the uncertainty they bring, so prices drop and may not really recover until peace and stability are restored. That's at least how one could interpret the data from the two world wars. However, if we look at the more limited wars the U.S. fought in the post-World War II period, the picture gets more complicated. We could not find a hard rule, but as so often in finance, it all seems to have depended on the specific circumstances of the conflict. The Korean War from 1950 to 1953 saw an initial sharp sell-off when North Korea invaded the South in a surprise attack. But prices recovered within 2 months or so and actually went straight into a real bull market, driven at least partially by the increases in defense spending. On this chart here, you basically don't even see the dip, only the rising stock prices. So, in the case of the Korean War, an investor who would have bought the initial dip when the bullets started flying, so to speak, would have seen his or her risk appetite paying off quite quickly. Vietnam was a completely different story. The war had been going on since at least 1946 between North Vietnam and French forces in the South, and U.S. involvement grew gradually as we took over from France. Now, on this chart, we have put the yellow box from 1965, when the U.S. began its major troop buildup, to 1975, when Saigon fell. But you could cut it differently as well. From a market perspective, it was all a long, messy quagmire without a clear beginning or end. There was no dip at the beginning, but later a lot of instability and smaller bear markets, like this inflationary bear market here around 1970. As it became increasingly accepted that the U.S. wouldn't win the war, the stock market began to fall in December of 1972. And then worse came to worse. Inflation, Watergate, the oil price shock of 1973, and the market didn't recover to its previous peak until June 1983, 10 years after the U.S. had withdrawn its combat troops and 8 years after the fall of Saigon. Overall, there were very few winners during this period. In fact, it was so bad that the bear market from 1972 to 1983 ranks as the third most painful market episode in U.S. history. After 15 years without a major conflict, the first Gulf War of 1990-1991 was short and achieved its aim, the liberation of Kuwait from Saddam Hussein's troops decisively and with minimal U.S. losses. You almost can't see the blip on this chart, but from a market perspective, it was like the Korean War in time-lapse, a sharp but short market crash of about 20% in the run-up to the war, followed by a sustained bull market that lasted until 2000. A buy-the-dip strategy would have yielded ample profits again in this case. The second Gulf War, or Iraq War, started with the U.S. invasion in 2003 and ended with the final withdrawal of U.S. troops in 2011. Now, this one was messy again, and particularly hard to interpret, as it happened before the backdrop of what Morningstar calls the lost decade, a period of actually almost 13 years from 2000 to 2013, when first the bursting of the internet bubble and then the great financial crisis seemed to merge into one large, never-ending bear market. Marcus and I still remember these years. They were not fun from an investor's perspective. Small wonder, then, it has the second worst pain index of all time in the Kaplan ranking, behind only the 1929 crash. That said, there were some tactical opportunities during this period as well. For example, the market dipped by more than 10% in the immediate run-up to the invasion of Iraq in 2003, and then shot up again after U.S. troops achieved a quick victory over Saddam Hussein's army. But overall, it was messy, and the ongoing costs and losses from the occupation of Iraq will not have helped the market and economy. Ukraine is another complicated example. When the war started, the market had already begun to come down in the immediate aftermath of COVID and the following inflation. The actual Russian invasion pushed the market down even more when it happened, but it was then followed quite quickly by a recovery that seamlessly evolved into the tech bull market that we've seen recently. So for the purposes of this chart, The Ukraine bear market lies already behind us, and anyone who bought at the depths of the market would have reaped nice profits. In real life, of course, the war is still raging in Ukraine, with no end in sight, and nobody knows where this will all end. And this is even more true for the war in Iran at the time of this taping. Markets overall have been quite muted in their reaction so far. There was no sharp dip in equities, at least not at the moment. And it's mostly the oil price that has gone up dramatically in the wake of most oil tankers avoiding the Strait of Hormuz. Again, no one has a crystal ball, us included, so we'll need to wait and see. But drop us a note below. Where do you think we're headed with the current conflict in Iran? Will it be a scenario like the first Gulf War? Short, quick, and followed by a market rally? Or are you more afraid of an Iraq war scenario? Initial military success, but then a seemingly never-ending, dragged-out conflict that weighs on markets. And what's your investment strategy for uncertain times like these? Are you looking for a safe haven for your money? Or do you rather see an opportunity to buy low in the hope of selling high in the not-too-distant future? Depending on your answer, you might consider different investment options for your portfolio, which leads us directly into the next section of today's discussion. Should you hold cash, bonds, or stocks if you fear a recession is coming? As I always say, everyone's financial journey is different. So whether you prioritize cash, bonds, or stocks in your portfolio, if you fear that a bear market is coming, whether triggered by a war or some other event, it will depend on your individual circumstances, goals, and expectations. That said, there are some general comments we can offer based on how close to or far away from retirement you might be. Let's start with the first group of savers, those who are several decades away from retirement. And let's take the lost decade as an example. As our Diamond NestEgg regulars know, Marcus and I both lived through this one, as I touched upon in the previous section. We were in our 20s and 30s back then, still young and fresh in our careers, so to speak, putting money into our retirement accounts with every paycheck, regardless of whether the market went up or down. Yes, it was painful to see our portfolios in the red much of that time, and equally painful to see basically no organic growth in our portfolio for 10 plus years. But we knew that we didn't need that money anytime soon, that retirement was very, very far away. And we also expected that eventually, at some point, the market would go back up again. So we just kept dollar cost averaging into it. And let's just say that the strategy of riding the wave down and then riding the wave all the way back up and beyond, it has worked out okay for us, at least so far. And if you're still many years from retirement, like Marcus and I were when the lost decade hit, then you may want to consider staying invested in the stock market despite the current wars and general uncertainty. Because what Kaplan's chart also shows us is that after these long bad periods, when the market goes up eventually, it goes up quickly and steeply, like here and here, as well as here and here. It's basically near impossible to time when these upward spikes will happen. If we take the 95 and a half years from August 1st, 1929 to January 31st, 2025, there were a total of 34,882 days, of which approximately 25,624 were days in bear markets. That means that over this 95 and a half year period, investors spent 73.5% of their time in bear markets. What this also means is that unless you can figure out in advance the 26.5% of the time during this period when the market was outside of bear market territory and generally skyrocketing upwards, it may be wiser and easier to simply stay invested through the ups and downs if you have a long enough time horizon and risk appetite for it. Otherwise, you may miss the rapid spikes like these here that usually come after a period of bad market patches. So, that was the first group of savers, those who are several decades away from retirement. And even though the lost decade was many years ago, this is still the group that Marcus and I would put ourselves in. Let's just say raising 4 kids in this country is not cheap. The second group of savers are those who are 5 to 10 years from retirement. This is a very special group because you're not so far away from retirement that you can just ride out a long extended market downturn, but you're also far enough away from retirement that you don't want to miss the next market pop upwards. And much of your decision on how to invest will depend on your outlook, risk profile, and how big your nest egg is, among many other factors. You need to know your numbers very well. So, if this were me and Marcus, what we would do is to give ourselves a budget for staying in the market, but only after we figure out how much we would roughly need to cover our basic expenses and build out the principal and cash flow for that via a combination of safe treasuries, higher yielding bonds, and annuities. Fixed indexed annuities would be something that I would seriously consider here because they would allow us to fully and completely protect our principal for retirement, while at the same time giving us equity upside exposure up to a certain predefined cap. Check out this video here, linked below, if you want to learn more about fixed indexed annuities, or email us at jennifer@diamondnestegg.com to get connected with our trusted annuity specialist. Now, if you're in the second group of savers and you like the principal protection and equity upside exposure that fixed index annuities provide up to a certain predefined cap, but you prefer something more liquid, then stay tuned because we'll have some more options for you in future videos. Or if you have a specific investment idea that you're already considering and you want a second or third pair of eyes to have a look as well, then come join our private VIP investment community. Because that's what Marcus, our VIP members, and I talk about on a daily basis. If you're in the second group of savers or the third group, which we'll be getting to shortly, you should know that there are quite a number of relatively safe and or stable, higher yielding income opportunities out there that you can mix and match within your portfolio once you've built the foundational pieces with safe treasuries, other types of bonds, and annuities. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more and join our member conversations. I've also linked everything below this video for your convenience. Continuing with our third group of savers now, those who are about to retire, say 5 or less years, or already in retirement. I've said this before, but during highly volatile and uncertain times like these, when some folks may feel that they wake up to a different economic landscape every day, I think it's important for me to say it again. If this is you and you've been considering going long on bonds and you have a strong opinion that a market crash or even possibly a recession is near, your best bet may be to start moving some of your cash, money market funds, and T-bills into longer dated bonds or annuities to lock in the current rates before they come down. This might especially be something to consider if you're already in retirement and have no appetite to wait out a potential downturn in interest rates and or need the income. And if you've already been dollar cost averaging into longer dated bonds, you may want to increase the amounts you've been buying because, as we've talked about often on this channel, the classical way to combat bad economic times is to lower interest rates as a means of encouraging economic growth, meaning that the yield you're currently getting on your T-bills, money market funds, and cash will likely go down. Also, keep in mind that even though the Fed generally only controls short-term rates, long-term rates have, in the past, tended to follow a similar downward path when there is a fear of a recession. This means that all else being equal, longer-dated bond yields would also likely come down. Again, this is not to say that a market downturn, recession, or worst case, a multi-year bear market is coming, despite the current war in Iran and market uncertainty. But if you fall into this third group of savers and the possibility of a market downturn and its impact on your portfolio is keeping you up at night, then you may want to consider shifting more of your portfolio to longer dated treasuries and CDs and annuities so that you can sleep better at night. Not everyone has the same perspective, but in my mind, at a certain stage in your life, a good night's sleep and peace of mind, it's worth a lot more than the possibility of maybe making a few extra basis points. Whether it's worth it to you, though, is something that only you can decide for yourself. And of course, if you have enough money set aside to cover your regular living expenses and emergencies, no matter what the markets do, then you may also want to just stay put. In this case, you could just continue hanging onto your dry powder, earning the current yields for as long as they last, and possibly scooping up some low-cost equities whenever the market hits a patch that looks like a buying opportunity for you. This applies regardless of whether you fall into the first, second, or third group of savers. So, on that note, let's move on to the next section of today's discussion. What are some additional words of caution that we'd like to share with you during these uncertain times? In times of great unpredictability, when there's so many unknowns, there are at least 3 things to remember. First, stay informed of what's going on, but don't panic. I don't think I'd be overstating this when I say that our Diamond NestEgg community is pretty much filled with savvy, level-headed, and well-informed super savers, members, and investors, because they do often watch videos like this one. But not all videos and stories out there during crazy times will be educational and sober. So you see or read financial headlines that don't necessarily lower your blood pressure and anxiety. Just remember this: panicking and making rash decisions with your money is almost never a recipe for financial success. Second, always remember the investing mantra: higher risk, higher return. It's been our experience that when markets turn uncertain or south, some investors get desperate for higher returns. If you come across a fixed income investment, or any investment for that matter, that sounds too good to be true, please do your homework first and make sure that it is a legitimate opportunity that is suitable for your risk-return profile before throwing any of your hard-earned money at it. Or come on over and join our private VIP investment club and see what we and our VIP members think, because not all risk is necessarily bad risk. The key is understanding what the risks are and how much you're willing to take on based on your personal situation. Think of our VIP investment club as your personal retirement and investment community where you can get the answers you want on international investing, covered call ETFs, or other top-yielding income alternatives. I've included all the links below this video for your convenience. Moving on to the third thing to keep in mind. Be very, very careful of scammers. Scammers have always been around, but it seems that they really are everywhere these days. So if you get an email or a phone call that seems even slightly fishy, please don't respond, and do not click on any links unless you know the sender of an email. So, how are you feeling about our ongoing war, conflict, etc.? And how do you think they will impact markets? Do you fall into this group 1, group 2, or group 3 of savers? And what are you doing with your money right now? Drop a comment below and let me and everyone else know. All right, members, super savers, and Bond Course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.